Welcome back to Chapter 2. We'll now continue with nominal versus real GDP. South African GDP was 3.1 trillion in 2012 compared to the more than 5 million rand in 1960. Does this mean South Africa's GDP has increased 600 times? Answer is no. Increase is due to price increases rather than an increase in quantities produced. This leads to the distinction between nominal GDP and real GDP. So nominal GDP is the sum of the quantities of final goods produced times their current price, and real GDP is calculated as the sum of the quantities of final goods times constant prices. And constant prices are the base year price, and the base year implies the year in which prices are set in. Calculation of real GDP. So we know how to calculate nominal and real GDP. So nominal GDP, we said, is quantity times current price, and real GDP is quantity times base year price. And just like I mentioned earlier, the base year implies the year in which prices are set in. So let's look at an example. We have the years 2004, 2005, 2006, the quantity of cars for each year respectively, prices of the cars, and we now have to calculate the nominal GDP and the real GDP. And the base year is 2005. So when we look at the nominal GDP for 2004, it's 20,000 Rand times the 10 cars. For 2005, it's 24,000 Rand times 12 cars. And for 2006, it's 26,000 Rand times the 13 cars. Then for real GDP, it's going to, so since 2005 is the base year, we will use the value of 2005, which is the 24,000 Rand. So for 2004, it's going to be the 24,000 times the 10 cars. For 2005, it's going to be the 24,000 times the 12 cars. And for 2006, it's going to be the 24,000 times the 13 cars. And then you can use this as an exercise. So try to calculate the value of A, B, C, and D. And just remember that the base year is 2005. GDP levels versus growth. Nominal GDP per capita, and per capita means per head, is nominal GDP divided by the total population, and real GDP per capita is real GDP divided by the total population. So to calculate GDP growth, you will have the GDP in the current year minus the GDP in the previous year divided by the GDP in the previous year times 100, or YT minus 1 divided by YT minus 1 times 100, and T denotes the time, the period or the year, as T minus 1 denotes the previous year. Let's look at an example. So why can we not calculate 2004's growth rate? Because when we look at the formula, we can see that we need the previous year's figures, which in this case is the 2003 value. So this you can also use as an exercise and try to calculate the growth in nominal GDP 2005 and 2006, and the growth in real GDP for 2005 and 2006. Business cycles. Business cycles shows periods of expansion followed by periods of contractions. Periods of positive GDP growth are called expansions, and periods of negative GDP growth are called recessions. Unemployment rate. This section we'll look at the unemployment rate. So let's start with definitions. Employment is the number of people who have a job. Unemployment is the number of people who do not have a job. The unemployment rate is unemployed divided by the labor force. Discouraged workers are the unemployed who have given up looking for a job. The narrow unemployment, also known as strict or official unemployment, only takes into account those who are unemployed. So it excludes discouraged workers, whereas an unemployment definition that includes discouraged workers are known as broad unemployment. Labor force is the sum of employment and narrow unemployment. So basically employed plus unemployed. The slide shows an outline of the population. And then, why do economists care about unemployment? So they care about unemployment for two reasons. Firstly, they care about unemployment because of its direct effect on the welfare of the unemployed. Individuals are often unemployed for long periods of time, and this also strain public resources. For example, people will now need unemployment grants. Secondly, economists also care about the unemployment rate because it provides a signal that the economy may not be using some of its resources efficiently. Many workers who want to work cannot find work. The inflation rate. Inflation is a sustained rise in the general level of prices or the price level, whereas deflation is a sustained decline in the price level. The inflation rate is the rate at which the price level increases. The GDP deflator. We saw earlier that nominal GDP increases faster than real GDP. The GDP deflator, defined as PT, T is a year. So the GDP deflator in year T, PT, is defined as the ratio of nominal GDP to real GDP in year T. And then we have the rate of change. So the rate of change, which is denoted by pi, gives the rate at which the general level of prices increases over time. CPI or Consumer Price Index. The average price of consumption or the cost of living is different to price increases in general. CPI gives the cost of specific items and services over time. The CPI is an index. It is set equal to 100 in the period chosen as the base period. So why do economists care about inflation? During periods of inflation, not all prices and wages rise proportionately. Because they don't, inflation affects income distribution. Inflation leads to uncertainty, and this in turn affects investment and taxation. Short, medium, and long run determinants of aggregate demand. The short run is a year. So year-to-year movements in output are driven by movements in demand. Changes in demand, perhaps due to changes in consumer confidence. Then the medium run, a couple of years, for example, a decade. Over the medium run, the economy tends to return to the level of output determined by supply factors such as capital stock, the level of technology. And then lastly, the long run, which is more than a decade, we look at the education system, savings rate, and the role of government. And that is all for chapter 2. Thank you.